The stock market has never been higher. Week after week, the S&P 500 continues to break new record highs, and yet, investors' sentiment remains negative. In fact, the sentiment index shows that we are in deep fear territory. And honestly, it's not hard to see why. We are currently in record high valuations territory, where the last time this happened, the market crashed by 50%. So what should you do? Should you keep buying and hope that the market doesn't crash? Or should you stop investing, maybe even sell everything away and wait for the drop that will inevitably come? In this video, I'll be showing you some surprising data that challenges what most people believe about investing at all-time highs. But before that, let's talk about one of my favorite games of all time, Tetris. For the longest time, the Tetris world record was held by Thor Ackerlund, a gaming prodigy who won the 1990 Nintendo World Championships and was widely regarded as the best Tetris player of his era. For more than 3 decades, no one managed to surpass what he and a handful of early champions achieved on the original Nintendo console, and that was because the game seemed to have a built-in ceiling, level 29, a point where the blocks fell so fast that human reflexes simply couldn't keep up. For years, people thought that it was unbeatable. But then, in 2009, a player named Harry Hong became the first person to officially max out the game, hitting a score of 999,999. What followed was a new era. Over the next decade came a generation of players who developed faster techniques, new controller grips, and mind-boggling reaction speeds that kept pushing the record higher and higher. Then, in 2023, a 13-year-old named Willis Gibson finally made history by becoming the first human to ever beat the game entirely, reaching the kill screen at level 157. What it shows is that what once seemed impossible can eventually be even surpassed. The limits we imagine are often just milestones waiting to be broken. The same can be said for the stock markets as well. Each time we reach a new all-time high, it feels like we have hit the ceiling, that prices couldn't possibly go any higher. Yet, history keeps proving us wrong time and time again. Since 1950, the US stock market has made 1,325 all-time highs. That works out to roughly 17 new records every single time. And during that time, the US stock market was within 5% of its all-time high about 60% of the time. In other words, the market spends a lot of time at or near record highs, and whenever it happens, the media loves talking about it as if it's something unusual.
Record highs again.
Record high.
At a record high.
Each time, investors question whether that particular high is the right time to invest. But standing where we are now, at yet another all-time high, we know that the answer has almost always been yes. But of course, what we really want to know is how often does a crash actually happen after the market hits another all-time high? Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. According to the data, not very often. From 1950 to 2025, whenever the US stock market hit a new all-time high, over the next 1 year, it fell more than 10% only about 9% of the time. In other words, it stayed positive or flat roughly 91% of the time. Over a 3-year period, those odds rise even further. The market has stayed positive around 98% of the time, and over 5 years, there's never been a single period where the market was down by more than 10% after hitting a record high. At least not yet. To put it simply, record highs are far more often followed by more highs and not crashes. In fact, JP Morgan found that investing at all-time highs has on average led to better performance than investing at any random day over 6 months, 2-year, 3-year, and 5-year periods. Investors who bought at record highs actually earned higher returns. The only exception was the 3-month period, where investing at an all-time high underperformed by just 0.6 percentage points, a difference so small that it barely matters. What's significant is that this dataset spans from 1988 to 2024, a period that included multiple recessions, a dot-com crash, the global financial crisis, the COVID crash, and countless other market corrections along the way. Yet, despite all the evidence, many investors still hesitate. One study by Fidelity found that 43% of investors have increased their cash holdings in recent times, citing concerns over volatility and weak confidence, while nearly 1 in 5 say that they have reduced their investments. Holding cash certainly feels safe, but over the long run, that safety comes with a huge cost. Schroders ran a fascinating backtest, simulating what would happen if an investor moved to cash for 1 month every time the market ended the previous month at an all-time high, and only switched back to stocks once it wasn't. The results? Over time, that investor would have ended up with about 90% less wealth than if they had simply stayed invested through it all. Our brains are wired to find patterns. After a number of good years, we instinctively assume that a bad year must be coming. But the stock market doesn't work like the seasons. It isn't cyclical or predictable in that way. If we plotted all the annual market returns on a chart, they will form a bell curve, but tilted towards the right, showing that roughly 70 to 75% of the time, market end the year with gains. And the reason is simple. The stock market reflects the cumulative value of human productivity, innovation, and progress. The combined efforts of millions of people and businesses creating new products, solving problems, and driving the economy forward. Over time, that collective growth compounds, lifting corporate earnings and valuations along with it. So it's only natural that the markets do the same. That's also why all-time highs tend to happen in clusters. Once strong fundamentals like earnings growth, profit margins, and technological breakthroughs start to align, they can create strong momentum that pushes the market to not just one new high, but a whole series of them. Now, of course, that doesn't mean the stock market will go up forever. History has shown that even the strongest bull runs will eventually face pullbacks. From the crash of 1987 to the dot-com bubble in 2000 and the global financial crisis in 2008, every bull market will eventually meet its breaking point. And 2025 feels especially fragile. Today, the market's gains are dominated by a handful of mega-cap giants, the so-called Magnificent Seven stocks. Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla now make up almost 30% of the entire S&P 500's market cap. The IMF has recently sounded the alarm, warning that if these big tech companies fail to deliver earnings strong enough to justify such lofty valuations, the market could face a sharp correction as inflated prices collapse under their own weight, leaving the broader market vulnerable to a downturn. Adding to that is the rise of circular deals, where big tech companies are increasingly both suppliers and customers within the same AI ecosystem. While this is a self-reinforcing loop that accelerates growth, it also inflates valuations and creates interdependence. If one part of the chain weakens, it could affect the rest as well. It also doesn't help that valuations remain stretched. The S&P 500 is currently trading well above its long-term average forward PE ratio. While this doesn't necessarily point to an imminent crash, history shows that periods of higher valuations tend to produce lower annualized returns over the following 5 years. But as of now, it still seems like history is on our side. Whenever markets have posted 6 consecutive months of gains like it has just done right now, the following year has ended in the green 81% of the time, with an average return of nearly 10%. Momentum, as it turns out, is a powerful force. At the same time, we have just come out of a near bear market in April, which has since reversed sharply upward. Historically, when markets rebound this strongly after brushing against bear territory, the months that followed typically delivered above average returns. Meanwhile, corporate fundamentals remain strong. According to JP Morgan, earnings growth is expected to remain solid in 2026 and 2027, with double-digit increases driven by AI adoption, automation, and margin expansion. Now, don't get me wrong, I'm not saying a crash won't happen. Knowing my luck, it might even come the day this video goes live. But even if the market does drop, the truth is you haven't lost anything until you sell. Given enough time, markets have always recovered. At worst, you will experience temporary decline. At best, it's an opportunity to buy more at lower prices. I'm investing for the next 10, 20, or even 30 years. So what happens next week or next month doesn't matter. Short-term pullbacks are part of the journey and not the end of it. In fact, people lose far more money trying to time the markets out of fear than from the downturns themselves. No one can predict exactly when the next crash will happen, and even if a correction does come, selling away and getting back in is far harder than it sounds, because you have to be right twice. First, you have to sell right before the drop. Then, you have to buy back in before the recovery. Most investors fail at one or both. That's because most people wait for things to feel safe again before they reinvest. And chances are, by the time they do, prices have already rebounded, the recovery is well underway, and they end up buying back higher than where they have sold, while turning a temporary dip into a permanent loss. As Peter Lynch once said,
"There's always something to worry about."
And indeed, there always has been recessions, wars, inflation, pandemics, financial crises. And yet, somehow, the market has always managed to keep climbing the wall of worry, reaching new highs time and time again. If there's one thing Tetris has taught us, is that what was once seemed impossible will eventually become routine. For decades, players thought that level 29 was the limit, until new techniques, better reflexes, and fresh perspective broke through it. The same goes for the stock market. Every all-time high feels like the top, until progress pushes it higher again. Markets don't rise because they are lucky. They rise because human innovation keeps moving forward. Each new high represents not a warning sign, but a reflection of collective progress of more productivity, better technology, and stronger businesses. So yes, a crash will come someday. But for long-term investors, that's not a reason to stay out. It's a reason to stay in. Because if history has shown us anything, it's that the biggest rewards go not to those who wait for the perfect moment, but to those who stay invested through every level, no matter how fast the blocks starts to fall.